We don't want to become that guy who promoted Bitcoin and told everyone to mortgage their houses for whatever. I forgot his name. Something about sailing.
Yes.
Well, hello there, my friends. Rafi here from the End Game Investor with this week's Silver Report for Arcadia Economics. And today, I wanted to go into what is turning out to be the longest monetary deflation ever since the Fed has taken records since 1982. And by monetary deflation, I mean the money supply contracting. I don't mean prices falling, and because they are not. The different countdowns that we can calculate from registered gold and silver in accordance with the new article out by Ronan Manley of Bullion Star, and some little hype-ish article that came out in Zero Hedge that people should be careful of, and I'll explain why in this silver report. And also there's the matter of Janet Yellen coming into the media and saying that she's considering Treasury buybacks of specifically the 20-year Treasury. What does that mean for the Treasury? How does that screw up its finances even further? And it does. And how much money does the Treasury really have to do this? And how many 20-year bonds are outstanding? I'll have the answers in this week's Silver Report. This week's Silver Report is brought to you by Fortuna Silver Mine, symbol FSM. They are set to release third quarter results on November 9th with a conference call on November 10th. And if we look at the recent price action in this stock, you see that it looked like it made a firm bottom at around $2 on September 26th, and it has been failing to regain the 50-day moving average since before June, I think, when the precious metal started to tank around April, but has since went above the 50-day moving average, and now it has tested it as support, and it is back near its highs of around $3 and let's say 10 cents. So we'll see what the stock does. It is struggling, as all silver stocks are, but the company is fundamentally sound and is still profitable, and it can handle these levels of silver for quite some time. So we'll see if this ends up being the final bottom. There's a very good chance, and it looks like we are finally seeing some signs of technical strength in the short term. As you know, my thesis is that the longer that gold and silver remain depressed with the physical price way above the spot price. I think physical premiums in gold are about 10% now. It has never been that high. Not even during the financial crisis of 2008 has it been that high. And physical premiums in silver and junk silver at least are around 42 to 45%. And in silver eagles, which we'll discuss in a second, they're around 75%. And there is significance to that. And so as long as the premiums stay elevated, and they will stay elevated as long as the spot price is so depressed, that means that the central piles of gold and silver are going to continue to drain as the arbitrage is in the physical markets right now, and it is very glaringly obvious why. In the registered gold category, we have what is now 11.5 million ounces left, down from 18 million ounces in the middle of June. So by those calculations, we have about 7 months left to zero in COMEX registered gold. That's just 7 months. So if we can maintain these depressed gold prices for that much longer, then yeah, registered supplies will probably zero out. Will we maintain this level of low gold for that much longer? I don't think so. The question is what happens when the gold price rises. Will the COMEX stockpiles go back up, or will they continue to drain as the premiums stay ahead of the spot price? And that depends on whether the dollar obviously loses its purchasing power relative to goods or not in the next 7 months. I think there's a good chance that we see a drain in the dollar's purchasing power, but it is something we're going to have to see. As for total gold, total supplies of gold, including eligible and registered, that is the supply pledged to deliver against contracts and the supply that's just sitting there owned by whoever, and we're going to get to who might that be in a second. We have about 9 months of supply left. How do I get to 9 months of supply? Well, by these calculations, we have 37 million ounces by the first week of May or so, and now we have 25.54. By those calculations, then we have about 1 year left of total gold supplies. However, there was an article out by Ronan Manley of Bullion Star recently, which reiterated the situation that we saw in April 2020, that the COMEX admitted that 50% of its eligible gold stocks are not available, and they are privately owned, and they are not really part of the COMEX stockpile. Now, this is not a new development. This has been around. We've known this for years. This is just being reminded. We're being reminded kindly by Ronan Manley that this is the case, and therefore not to count all of the supplies, which is why I cut 12 down to 9 to take out 50% of the eligible stockpile. We also see that in registered silver, the drain continues. We are down. Last week we were at 40. Now we are at 35.93. The drain continues, and it is continuing fast, and it is accelerating. Since silver squeeze, I think near 120 million or 115 million or something like that ounces have been drained from the registered category. And we just had our recent step down of about 2 million more a few days ago. And this trend just keeps continuing because the spot price is so depressed. So we have about 4 months left in the registered silver category. After that, who knows what happens? We'll see, but we're getting close. And now let's talk about what Janet Yellen said about Treasury buybacks. Is this possible? And what does it do to the Treasury's finances? Well, it doesn't do anything very good for it. And we're going to go into the numbers right here. Bloomberg, Yellen flags potential for buybacks of Treasury's securities. Treasury chief notes relative illiquidity in 20-year bonds. Yellen notes that other nations conduct buyback operations. Well, that's nice. Maybe it was Zimbabwe. Who knows what other nations it was? Let's see if this is even possible. Let's take a look at the yield curve. The yield curve is the various yields at different maturities. We're talking about the 20-year bond here. So the 20-year bond has a yield of about 4.38, which is above the yield in the 30-year, which, yeah, it does signify the 20-year bond is illiquid, and there's a little bit of a problem with its yield. So the theory is that if you buy back the 20-year yield, well, you're going to have to move all that debt to the front end here, which is most of it is above the 20-year rate. 4.38, and the 6-month is 4.47 above that. So if you're going to buy back treasuries at 4.38 and sell them at 4.47, you're actually losing money. So it's crazy, unless she wants to put it to 1 month, which means that she would be buying 20-year treasuries and then having to roll them over every month. How much in 20-year treasuries are actually outstanding? Well, we have here SIFMA, and let's zoom in a little bit. Bonds, 20-year, I have that column here highlighted. And 20-year bonds outstanding. This is all since 2020. The 20-year bond is relatively new. It was reintroduced in 2020 during the COVID lockdown insanity loveliness. And we have here some. It says 1.3821. That is $1.4 trillion of 20-year bonds. Now, can they roll all that over to a 3-month bond? No. And this is the Treasury's bank account at the Fed. You can see here that it's relatively stable from around 1986 to 2008. It's usually close to zero, $4 or $5 billion. And then 2008 starts to get a little bit wobbly. And then woo, here's the lockdowns where we have a peak of about $2 trillion, $1.8 trillion. And then all that money comes into the economy as they spend it down into December 2021. Now they have about $607 billion left. So not close to $1.38 trillion. This is the maximum rollover that they could do, or moving the 20-year treasury to the 6-month or the 3-month or whatever. They could do $600 billion worth, and then they're going to have to sell a lot more on the front end. But then what happens when they do that? When the treasury sells a 20-year bond, they lock in that interest rate for 20 years. If they sell it at, let's say, a rate of 3%, then they're paying 3% on their bond. It could be on the secondary market that somebody takes that bond in the secondary market for a lot less than the primary guy who bought it. And then functionally they get a higher rate. Let's say they bought it, the first guy bought it for 100, and then, then the next guy bought it for 90. So the treasury is paying the same coupon, except the guy who invested 90 gets a higher percentage from that coupon on his original investment. But either way, the treasury is paying the same interest rate. The thing is, if they roll it over to a 3-month or 6-month, then they only lock in that interest rate for 3 or 6 months. And whenever the Fed raises rates, or whenever the interest rates go up on the short term, then interest payments go way up, because every time they roll it over, they got to pay the new interest rate again. So this is really going to deteriorate the finances. If they want to move $600 billion of debt from the 20-year to the 3-month to the 1 month to, get a lower rate, then they're going to screw themselves over pretty fast. And if they want to roll it over to the 6-month or the 1 year, they'd be paying a higher rate anyway. It would be even worse. So there's not really much they can do, and this is not going to solve any of their problems, even in the short term. This is the most updated chart I have of the 13-week average annualized money supply growth rate. And this chart goes back to 2006, but I checked the raw data, and going back all the way to 1982, this is the longest and deepest absolute deflation of the money supply ever. Whenever you have the blue line here going below zero, you have absolute deflation, meaning the shrinkage in absolute terms of the dollar supply within the United States banking system. And it has been below zero since the end of June, and we are now we have data current to the first week of October, and we are still negative. And when you look at the raw numbers, these are the raw numbers over here. This is the weekly M2 non-seasonally adjusted money supply numbers. You see pretty much a smooth continuation here from around 2011 to 2020, and then here's the COVID printing. But here, check out this actually pretty big fall here from, looks like April 25th, just prior to tax day, April 11th, just prior to tax day. And the money supply is continuing down from a high of about $22 trillion around tax day, April 2022, and now to around $21.3 trillion. Now, if we zoom in here, we can see that the deflation has been accelerating since April 18th. We had a big drop off, which is normal for that time of year. The thing is, we have not recovered at all, and we continue trending lower and lower and lower. We had a huge fall in the money supply of around $150 billion from September 19th to December 26th, and we still have not recovered that as we go into a new month. Typically, when we move into a new month here, every time there's a new, we transition into a new month, the first week of that month, we see a big explosion in money supply. We did not see that this week, so the run on the dollar continues, and that is going to continue until the Fed pivots, and the only thing that's going to make them pivot is a financial crisis, and this is the kind of stuff that causes a financial crisis. So when will the dollar lose its final vestige of purchasing power? When the Fed has to print one last time due to what it's doing here. A note of caution, and it is something that I try to clarify to my subscribers often at the Endgame Investor. I try not to be a hype-ish guy. I understand what the end game is. I understand that in the end, gold and silver are going to be the money directly, and I understand that those who hold them and stack them are going to be rich in real terms. I get that. I don't pretend to know exactly when this is going to happen, so I try to keep myself ever from saying, oh, now is the time, go all into silver, go all into gold right now, blah, blah, blah. I try not to do that. Now, I saw an article on Zero Hedge this week that got a little bit into the tones of that sort of argument. And I wanted to point out two specific things about this article and advise caution from ever becoming too emotionally manipulated in that sense to go all in on any specific day, on any specific news event. Rather, what we should be doing is taking a certain percentage of our income or our disposable income and putting it away in gold and silver each month, whatever makes us able to sleep best at night, knowing that we are increasing our stocks of real money without putting ourselves in any kind of liquidity danger. That is the balance that we must attain, because really we have to recognize our roles in this world as the adults in the room. We don't want to go too far either to one side or another, but understand where things are going and get there responsibly without getting too excited. We don't want to become that guy who promoted Bitcoin and told everyone to mortgage their houses for whatever. I forgot his name. Something about sailing. Yes. Physical silver demand source, bullion dealers offer huge buyback premiums. That is true. There's no lying in this article. It's just a little bit misleading because, first of all, it quotes Ronan Manley of Bullion Star, who says that 50% of deliverable silver on the COMEX is suddenly not available. Well, first of all, he doesn't say suddenly it's not available. This we've known since April 2020, and Ronan Manley made that clear. He was reminding us of a situation that was revealed in 2020 and keeping it on top of our consciousness. So here he says, oh, suddenly not available. Not exactly, not suddenly. So this is not, there's nothing new here. Second of all, this article says, second, the spot market for silver remains in backwardation. I am not seeing that. If you look here at the CME silver page, we have here the silver futures settlements. In October, the settlement was $19.48. In November, 1948.2, 1948.6. So the prices are going higher here as you go into the future. That is contango. If you want to look at backwardation, you can look at the crude oil futures price. And here you see that the prior settled at $87, and then it goes down 86, 85, 84. That is backwardation when the prices go down as you go into the future, and then go up as you go to the present, into deliverable. So I'm not quite seeing, I don't know where the numbers are coming from, but I'm not seeing silver in backwardation right now. It looks like Zero Hedge made a tweet about exclusive sell-back offers from APMEX and is saying that APMEX, for example, I'm highlighting here, is offering $10 over spot per coin right now. They are for certain things, or they were for certain coins, specifically Silver American Eagles, which have the highest premiums, about 75 to 80% these days. So if you're going to offer $10 back per coin, that's about a 33% premium over spot. And if they can sell it for like 80% over spot, they still got a pretty decent profit margin there. So yeah, it makes sense for specifically Silver Eagles to offer a $10 per over spot buyback price, but that's not the case for every silver coin. It's a special case for Silver Eagles. So don't get too hyped up by this article. There's nothing inherently wrong with this piece. It's just a little bit too frothy, I think. The goal that we have is not to time it perfectly and then get in at the very last minute so that we can time the collapse perfectly and then be rich. What we want to do is already be in position to take advantage of that collapse without having to worry about timing it perfectly, and be the adults in the room and understanding what's happening. This is Rafi, the Endgame Investor. If you enjoyed this video, then subscribe to a 2-week free trial of the Endgame Investor, or become my patron on Patreon, where you can get a weekly dose of biblical commentary on monetary and economic policy topics. Or you can watch my videos, which I do once or twice a week on YouTube, which is this website. And I put a lot of memes in. It's fun.